This example problem is about entries for capital leases from the lessee side. The problem reads, Goodrich has a long-standing policy of acquiring company equipment by leasing. Early in 2011, the company entered into a lease for a new milling machine. The lease stipulates that annual payments will be made for 5 years. The payments are to be made in advance on December 31st of each year. At the end of the 5-year period, Goodrich may purchase the machine. Company financial records show the incremental borrowing rate to be less than the implicit interest rate. The estimated economic life of the equipment is 12 years. Goodrich uses the calendar year for reporting purposes and straight-line depreciation for other equipment. In addition, the following information about the lease is also available. Lease payments are $55,000. The purchase option price is $25,000. Estimated fair value of machine after 5 years is $75,000. And the incremental borrowing rate is 10%. Date of the first lease payment is on January 1st, 2011. So what they want us to do is compute the amount to be capitalized as an asset for the lease of the milling machine. Prepare a schedule that shows the computation of the interest expense for each period. Give the journal entries for Goodrich's books for the first 2 years of the lease, and assume that the purchase option is exercised at the end of the lease, and give Goodrich's journal entries to record the exercise of the option. So, for number 1, to find the present capitalized value of the lease, on a financial calculator you're just going to enter in, there's 5 payment periods, the interest rate's 10%, the payments are $55,000. You use a future value of $25,000 because this is the purchase option price. So that's what we would use as the future value of the lease. And when you compute those, you'll get $244,866. Now we're supposed to prepare a schedule that shows the computation of the interest expense for each period. That's what this table is right here. So the way this works is in the top right corner you have $244,868. That's this number that we calculated right here for the present value of the lease. And then this is your initial balance. Your first payment is also not on the 11th, it's on the 1st as well. So it's the same day that the lease goes into effect, and so the first payment of $55,000, you have an interest expense of 0. So the principal, the amount going towards principal, is $55,000. The full $55,000. So you reduce the $244,868 by $55,000, and that leaves you with $189,868. And then on December 31st, that's the next payment, you would take the lease obligation from the previous, for what we just computed, you would times $189,868 by 10%, and that would give you this $18,987. You subtract that from the $55,000, and that leaves you with $36,013 going towards the principal. And then you just repeat that pattern. And so down here, you end up, that's rounding stuff, so that should be a 0. And these are your total amounts. So you've paid out $300,000, $55,000, $136 in interest expense, and the full amount, again, it's a rounding error, but this would be the $244,868. That's how much principal you've paid back. Now the journal entries for Goodrich's books for the first 2 years of the lease. Our first entry is to record the purchase of the lease. So we debit leased equipment. It's the total value of the lease obligation, the $244,868. We credit obligations under lease, capital leases, $244,868. On the same day, January 1st, 2011, this is our first payment. So we're going to debit this account that we put in right here, because we're taking away $55,000 of the principal against, or we're paying $55,000 against the principal, which is this. So we debit obligations under capital leases. This entry is to record the first payment on the same day the lease was purchased. There isn't any interest. The full $55,000 payment goes against the principal. Then you credit cash for $55,000, obviously. Now, a year later, on December 31st, 2011, we are going to debit obligations under capital leases, this time for $36,013. This entry is to record the second payment, and this one includes interest. And we just refer to the table that we made earlier to get these amounts. So the $36,013, this right here was our first payment with interest. You see the amount of principal payment is $36,013. That's what we're debiting right here. Now for interest expense, you have $18,987. If we go back to the table, that's right next to our principal payment we just mentioned. So you can just refer to this table for your entries. And cash is the actual payment amount of $55,000. Now on December 31st, 2011, we have basically a depreciation entry or amortization. You get this because Goodrich uses straight line depreciation. The estimated life of the equipment is 12 years. There wasn't a salvage value mentioned, so the calculation is just 244,868 divided by 12 periods, or 12 years. So that gives you 20,406. You debit amortization expense on leased equipment, and you credit accumulated amortization of leased equipment. Now on December 31st, 2012, we have our third payment, and we just refer to the table again to get the numbers. So you have a debit for $39,615, a debit to interest expense of $15,385, and a credit to cash for $55,000. And this is the exact same entry again at the end of the next year, or the end of 2012, for accumulated amortization and amortization expense for those same amounts. Now if we go back, we're supposed to assume that the purchase option is exercised at the end of the lease and give Goodrich's journal entries to record the exercise of the option. So if we come down here, that's what this entry is for the purchase. Now first, the credit is to leased equipment because the lease obligation is fulfilled in the full amount, $244,868. And you're going to debit accumulated amortization of leased equipment. This is the yearly amount of the amortization that we had, that was $20,406 each year, and we times that by 5 because the lease period was 5 years. And then this is just the balance of this entry, and this goes to equipment because we bought the equipment. This is the book value of the equipment, and that is everything required for this problem.